So we've come to the end. Chapter 13 is the big picture financial analysis. But before we can actually do some financial analysis, the first learning objective looks at some concepts that are important to sort of understand. Then we'll be getting into the analysis. Our first stop is going to be looking at something called horizontal and vertical analysis. So I think we'll be able to get through that today. And then the big kahuna is for next class, which is ratio analysis. All right, so these are concepts that are important to sort of understand. So the first thing is this concept called sustainable income. So what is sustainable, right? Sustainability, there's a lot of movement on that today. Sustainability is really what is able to be done on a regular basis that can be sustained over a long period of time, right? So for our discussion today, we're going to be looking at something called how much of our profit is really sustainable. How much of it is really sustainable? Sustainable income is looking at the level of profits that are able to be sustained over time. Okay. What interferes with sustainable income? Well, two things that we're going to be learning about. They're called unusual items because they are unusual. The first thing you'll be learning about is something called the discontinued operation. And then we are going to get into a little bit more detail in comprehensive income. Okay. But the purpose of understanding an unusual item is that a discontinued operation, particularly, is something that distorts the real sustainable income profitability of the company over time. So we're going to look at that. We're also going to look at how comprehensive income sort of distorts that a little bit as well. Okay. We have to look through those. So everything starts with an income statement. This particular statement is a statement of comprehensive income. So as you notice, after the net income or the net profit, they add the comprehensive item here. But you already kind of know how to read these income statements by now pretty well, right? Revenue minus cost of goods sold gives you the gross profit, minus all your operating expenses gives you the profit from the operations. Then you have that wonderful other category, right? Other revenues or expenses, other gains or losses. Gives you the profit before you pay income tax. You put an income tax expense in, and here's your profit from your continuing operations. So from the regular business itself, right, what's continuing, what you're going to continue to do is simply profitable, 146,000 here. However, as you notice, there's been a distortion. The first thing you notice here is in red, something called a discontinued operation. So to have a discontinued operation, you need to basically, you either sell off a division or a product line that you made to another company. So you're not making it anymore, you're discontinuing doing it. Or you close down a part of your business, you discontinue it. So discontinued operations only happen once. I mean, if I made a whole bunch of consumable products and I didn't want to make peanut butter anymore, and I sold that peanut butter division to another company, I can only do that once. Once I sell my peanut butter division, that's it. It's a one-time thing. So that's going to distort. That's an example of a discontinued operation. That's going to distort my profitability. I'm either going to lose money on that sale or I'm going to make money on that sale. And either way, if I lose or make it, I got to report it on my income statement. So it's going to distort my profits for that particular year or that quarter, whenever it happened. But doesn't really show as a sustainable profitability. Well, here, this company had some type of discontinued operation that netted them an additional $30,000 of profit. So look at their profit. Their profit is shown here as 176,000, right? Which is 30,000 higher than the profit from the businesses that are going to be continuing. Okay. Continuing operations are the business they're going to continue doing. And so here the company looks more profitable than it really is. But I doubt, it's not sustainable. It's not sustainable. This is sustainable. This is not. This is a one-time thing that's going to happen. Another thing that's going to distort the total profitability of the company is looking at what we call other comprehensive income, which in most cases is simply just taking into consideration an unrealized gain or loss. It's not realized, it's not real, it didn't really happen, but you have to show it. So in this case, this unrealized gain is adding $10,000 more to the total income of the company. So the company looks a heck of a lot more profitable after these unusual items have been accounted for, right? But how profitable is it? What's really sustainable? The continuing operations is really what's sustainable. Right? So that's something just to be aware of. It's important to sort of understand all that. They do go ahead and give you the definition of a discontinued operation, right? So basically, you either sold or closed a significant component of your business. Like I said, if I made a whole bunch of foods and I no longer want to make peanut butter and I sell that to another company, I can only do that once, right? So that's that. Of course, the income statement is going to be affected because you're going to have a gain or a loss on this. Anytime you sell something off or close something down, you're gonna need to look at a gain or a loss from that, and that's going to make your profitability look either much higher than it is or much lower than it really is. So that's just something that they want you to analyze and know about. So here's an illustration, and you'll only have a couple of these to deal with because it's important, but it's not everything. Here we have a company in 2017, Acro Energy. They had a profit before income tax of 800,000. Okay, that's sort of a starting point. So during 2017, they discontinued and sold its chemical division. Okay. So when you discontinue or sell your chemical division, you're literally selling that particular division to another company. So there's the sale of the company, that part of the company, but you're also closing down the operations, and you got to look at those here at your current site. So you're kind of looking at these things in two ways. First thing, you have a loss from closing the operations of $140,000 net, 60,000 taxes. Okay. So that's a loss from closing the operation on site. Then you, in this case, you sold the entire division. So all the assets, everything of the division went to another company, and you took a loss on that of $70,000. Okay, net of a $30,000 tax. So both things happened in this case. We also have to assume in this case that we are going to have an income tax expense eventually, so we're going to use 30%. And it asks us to prepare the statement of comprehensive income with the information that we have here. So basically what we're starting off with is the $800,000, which is your profit before taxes. You'll have an income tax expense. We use that 30%. 30% of 800,000 is 240. So that gives us our profit or income from continuing operations of 560. Now we have to note those discontinued operations. Okay. First, we had a loss from the operation of the chemical division, closing it here, of 140,000. And we had a loss from disposing of that division to the other company of 70,000. So in total, we have a total loss to report of 210,000 when we closed and sold off our chemical division. That has to be reported on the income statement. And look what happens. It shrinks our net income quite substantially this particular year, right? And so again, how'd the company really do? Well, it's whatever's continuing is really what's sustainable. What do we have to report? We had to report a much lower profit this year because of this very unusual item. We sold off a whole division, closed it, sold it off, sold our assets off, et cetera, and closed it here. All of that is looked at as two separate events. So we had to take a loss here. So when the stockholders look at this, they're going to say, "Oh, we only made 350. I thought we were more profitable there." Well, you were. What made it 350 is this unusual, irregular item. Okay. Nice little story about what non-recurring means, because some companies really do this more than they need to. Procter and Gamble had restructuring charges for 12 consecutive quarters. It's 3 full years. That's supposed to be, not supposed to be something that you do over and over and over again. So some companies can, abuse this idea a little bit in their reporting. Something to look forward to. Another thing to look at is comprehensive income looks at your net income from the company and then notes any gains or losses that come from, in most cases, it's usually for available for sale securities. So these are stocks, for example, that the company owns as investments. Now, those are long-term investments. If a company has stock in other companies, that would be an asset, long-term investment. But GAAP requires us to never overestimate and overstate the value of our assets. So if you have investments, they're going to change in value every period, right? So when those investment values change, they either go up or down, it creates what we call an unrealized gain or a loss. We have to report that as part of comprehensive income. And so that is either going to add to our overall profitability or subtract from it. But it really is something that's unrealized, because it's just, what is the value of these investments that we have right now? That's it. But it does have an impact on the income statement, the comprehensive income statement. So here's an illustration on how it would work. Again, accounting standards require us to adjust the market value of our investments, okay, at the end of every accounting period. So this is what happened here. During 2017, Stasi Company had purchased IBM stock for $10,000 as an investment. So it's sitting as a long-term investment. At the end of 2017, IBM stock is only $8,000 value. So what they have to do is report a $2,000 unrealized. They haven't sold the stock, they still own it, but the value has changed. So they have to report a $2,000 unrealized loss on their comprehensive income statement. So in almost all cases, it's going to be reflected here on this last piece. Okay. Most companies have these available for sale securities as their long-term investment. Okay. So one that you'll see is what's often put on the comprehensive income statement after the profit of the company is reported as net income. You will see their other comprehensive income. And in this case, the unrealized loss on their available for sale securities is $2,000. Right? The value of IBM stock went down $2,000. So now they have to put it as unrealized loss. So their comprehensive income is the net income plus or minus whatever their comprehensive income is, unrealized gains or losses. And that's basically it. But this format is normally what you're going to see. Another way they can do it is to put it under stockholders' equity, but that's not normally how we'll do it. Okay. So what you'll see here, and here's a corporation's statement of comprehensive income. What you'll normally see is, and this makes total sense when you get up to the profit from continuing operations. I think everyone gets this piece. We've seen this over and over again. What's different is all this red. After the profit from continuing operations, we have to list any discontinued operations and what its effect was. In this case, we had, for this particular company during this period of time, they recorded a loss from closing its operation of their plastics division. Okay. Their loss was $42,000 minus their tax. It was $60,000 minus their tax savings. So $42,000 is a loss. However, when they sold off the assets of that division, they made a gain. And so they had to report a gain. So this is going to take away from their profits, but that's going to add to their profits. Their total, the net between these two is they have to report another $7,000 loss from this. But that's a one-time event. So now their net income is $39,000, right? 200. But wait, there's more. Right? See, not a commercial. They also have to report that they had an unrealized gain on their available for sale securities. They had increased in value over that period of time. So they had to report an additional $10,500. They went up by $15,000, but they set aside 30% of that as income taxes. So the unrealized gain is the difference, 10,000. And that increased their profit. Their total comprehensive income is increased. So here we're talking about the difference between what's sustainable, because that's what's continuing over the long run for the company, and these additional items that we consider unusual. So you have to sort of know the difference between that. Things that could possibly impact sustainable income itself outside of these is that on occasion, their companies decide they want to change certain parts of their accounting principles that they're using. For example, they might change from FIFO to LIFO, or average cost, in which case they need to basically do some retroactive reporting to make sure all their numbers are now updated. Okay. Again, there are some interesting stories here about how companies have adopted approaches for gains or losses on their pension plans and other things like this. Okay. And how it resulted in expenses. What companies really need to focus on, and what you are learning a little bit about, is companies should do their best to highlight their quality of earnings. Okay. And that means they need to share all the information with their financial statement users so they give them a better understanding of how they came to this conclusion. And so that's really a very, very important type of thing, is to make sure all the information is explained well and transparent, so people who are using the financial statements can understand what they're reading. Unfortunately, with accounting scandals and pressure to be profitable every quarter, every year, whatnot, a lot of companies, spend too much time managing their income statements than their actual business. It's a criticism here, because they want their financial statements to look good, but that sometimes means something that's not full or transparent. So again, sometimes they switch accounting methods. Sometimes they don't recognize things properly, such as, all the revenue is not properly accounted for, expenses are not accounted for properly, liabilities are not all reported, things like that. So it affects the quality of earnings, and that's basically what learning objective is. One is really about. Learning about those unusual items, there's a end of objective do it exercise that you'll see as part of your homework as well. Here we have 2017 income statement information for Air Corporation. They have their profit before tax of $400,000. They have an unrealized gain on their securities of $100,000. Income taxes of $120,000. Loss from discontinued flour division, $50,000. Loss on disposal of the flour division, $90,000. Tax rate is 30%. So they want you to prepare a statement of comprehensive income beginning with the income before income taxes. So we start with that 400,000. We take 30% away for the income tax. That gives us $280,000 profit from continuing operations. Now we have to list our discontinued operations that were listed there. So here we had a loss of the flour division. Let's go back to the data so we can see this. The loss from the flour division was $50,000, but you had to put aside 30% of that for tax. So the actual, so 15,000 gets put aside for tax savings. So the actual loss is 35. Then when you dispose that division, you took a loss of 90,000, but again, you need to, is it 90,000? Let me go back and check the number. Yeah, 90,000. So you put 30% aside for taxes on that. That's 27,000 you put aside for taxes. The rest is your pure loss. Together, this is your total loss on your discontinued operations. Look how much it shrunk your profits. Right, down to 182,000. That's your net income. Now you have an unrealized gain from those securities. So you look back here, your unrealized gain is 100,000. You got to put aside 30% of that for taxes. So you're going to have an unrealized gain. You're going to add 70,000 here. That's the difference between 100,000 and the 30,000 you put aside for taxes. So your comprehensive income is 252. Okay. So just a quick break, coming back to the main class to see and touch base to see how you're doing on that. Okay. So again, just to the important thing, right? The unusual items, discontinued operations, very important to sort of understand that. The comprehensive income that we have to do unrealized gains and losses because the values of those investments are changing. We have to state that. So they have an impact on the real profitability of the company. Sometimes it makes the company look more profitable. Sometimes it makes it look less profitable. But we need to understand those differences. Is really the point of objective one. No. Woohoo! Are you ready for some analysis? Because here we go. Learning objective 2. We're going horizontal and then vertical. Amazing. Okay. All right, some fun stuff here. Learning objective 2 introduces you to something called horizontal analysis and vertical analysis. Now, you do not have to be horizontal or vertical to do these, but it's just looking at financial statements in a little bit of a different way. Okay, there are lots of ways in which we compare things, and these are some of the tools that we're using that you're learning about here. So horizontal analysis looks at trends. We're looking at what we call trend analysis. We evaluate financial statement data over a period of time. And the reason we're looking at a period of time is we want to see and take note of what is increasing over time, what's decreasing over time. And we can do this to balance sheets and income statements. Okay. So it's really not that bad thing to do. So here we have the Chicago Cereal Company. We have our condensed balance sheets for 2013 and 2014. You're looking at the differences from 2013 to 2014. You're looking at that in two ways. What is the actual amount, which in this case, the amount of current assets increased by 290 because it went from 2427 up to 2717. That's an increase of 290. Then we put it as a percentage. We put it as a percentage. To get the percentage, we will take the difference here, which is the 290, and divide it over the base year. The base year is the number from 2013. So the amount is the difference, and we'll put that over the amount in the base year. Okay, so in this case, the 290 is the amount that's different. The base year amount is 2427. And when you do that, you'll see it's an 11.9% difference. Okay, it's an increase of 11.9%. Same thing with our property assets. They went from 2816 to 2990. That's up 174. Take that 174, divide it on the base of 2816. We had an increase of 6.2%. Same thing with all the other assets. They increased by 219 in total. Put the difference over the base year, up 4%. And you can do that with total assets. Total assets increased from 2013 to 2014 by 683. 683 divided by 10,714 is a 6.4% increase in the total assets. And you do the same thing for the liabilities and stockholders' equity accounts. It's the exact same thing. You're looking at the differences between the base year and the most current year. You put the amount of the difference here, and you divide over the base year. So you see current liabilities barely increased. They increased less than 1%, 0.6%, and we went up a little bit. But long-term liabilities jumped 4% from 4624 to 4827. So they were up 202 divided over 4620. That's a 4% increase. So we do all of that all the time. Notice for treasury stock, even though it's a negative, it looks like a negative number, we do the same thing. It went from 912 to 1357. That's an increase of 445. 445 over 912 gives you a 48.8% increase. So I would just say for when you're doing these to ignore the signs per se and just look at the differences. Okay. So this is how to do horizontal analysis on a balance sheet. You need to have comparative balance sheets, the amount in the first column, the percent difference in the second. For an income statement, it works the same way. You also are going to need to look at 2 years, 2013 to 2014, based on all the categories. You're just noting the differences. What was the differences between 2013 and 2014? Net sales increased by 869. 869 divided by the base year of 10,907 means that your sales went up 8%. Okay. Again, cost of goods sold went from 6082 to 6597. That's an increase of 515. 515 divided by the 6082 base gives you an increase of 8.5%. And again, you're doing this all the way down. Okay. Now notice here, when you have a difference here between a positive 13 and a negative 2. So it actually went down by 15. That's a change of 15. 15 over 13 gives you this 115%. That's the difference here. But again, in this case, you're going from a positive 13 to a negative 2. That's 15 places to the left on the number line. So 15 over 13 is where you get that difference. Okay. In the case where it went down here, income tax expense went from 468. It went down to 444. So that went down by 24. 24 divided by 468 is 5.1%. But when you have a negative divided by a positive, your outcome is going to be negative. I don't want to sound negative, but that's the way it is. So again, that's horizontal analysis. 2 columns you got to create: the amount of the difference and what percentage that amount is. Percentage is the amount divided by the base. Okay. So that is your your horizontal. Now we're moving on to vertical analysis. Vertical analysis is, it's a very, very, very good thing to know. It's called common size analysis because we look at things as a percentage of a dollar, or percentage of a base amount. We can apply this to both the balance sheet and the income statement again. So we'll take one at a time. Here are the balance sheets. So when we're looking at the balance sheet, we are looking at 2 things, right? 2014 numbers are provided. 2013 numbers are provided. The difference is your assets are totaled. Your liabilities and stockholders' equity are totaled. So all of these are going to be a percentage of the base of total assets. So your total assets are 100% of your assets. Your current assets are 2717 divided by a base of 11,397. Your current assets represent 23.8% of your total assets. Your property assets are 2990 over a base of 11,397. Your property assets represent 26.2% of your total assets. That's how you need to read this. And again, it's the same for every year. This is a percent of a total. In this case, our total is assets for the first part of the balance sheet. Our total here are total liabilities and stockholders' equity. So everything is going to be a percentage from this part down is going to be a percentage of your total liabilities and stockholders' equity. So when you're looking at your current liabilities of 4,040, you're going to divide it over the total liabilities and equity of 11,397. That's how you're going to get that 35.5% of your total total liabilities and equity are current liabilities. 4827 for long term divided by 11,397 means that your long-term liabilities are 42.4% of your total liabilities and equity. Total liabilities of 8871 divided by the total liabilities and equity mean your total liabilities represent 77.9% of your total liabilities and stockholders' equity. It gets interesting when you get to stockholders' equity itself. Common stock's usually a small number. So it's the 493 divided by the total of 11,300. That's why it's so small. 4.3%. Common stock represents 4.3% of your total liabilities and stockholders' equity value. Treasury stock, remember, is taken away. So that's why it's in parentheses here. It's taken away from stockholders' equity. So it's clearly going to have the impact. You're still using 1357 divided by 11,397. but because it's a negative divided by a positive, your answer is going to be negative. Okay. So this is how you would do it for each of the years here. Okay, you're comparing each number to the base. In a balance sheet, you're going to have two bases. Your assets are going to be compared to the total assets. Liabilities and equity is going to be compared to total liabilities and equity. So you're going to look at these as like two separate sections to calculate. For income statements, it's interesting because your net sales are 100% of everything. Remember, in an income statement, everything starts with revenue. From your revenue, you subtracted all your expenses, and that's your income, right? We've gone through this before. So everything is a percentage of your net sales. So your net sales, this number becomes your base, 100%. So for 2014, you'll do it for both years, of course. You have your net sales of 11,776. That's 100% of your revenue. Your revenue is going to be split into your expenses and your profit, because that's how revenue is split. So your cost of goods sold, 6,597. You're going to divide it into the total revenue, total sales, and it represents 56% of the total. Okay. Your gross profit, which you've seen this, you've seen gross profit margin before, you've seen profit margin before. We did it back in, oh my God, what chapter was that? I forgot. But we did all this stuff before, right? Back in chapter 5 and 6. We've done, so you've seen these. This is just how it looks as a percentage. Your gross profit was 5,179 divided into the base of 11,000. It's 44% of that. Your gross profit is 44% in this case. Subtract out your selling administrative expenses, 3,311, based on a base of 11,776. That means your selling administrative expenses were 28% of the total. Your profit from operations of 1868 divided by the base of 11,776 means your profit from operation is 15.9% of your total revenue. And all the way down, you're basically just doing a percentage in this case. In this case, this number is so small, you're going to be required to just go to one decimal. So that's why it's 0.0. It's so small that when you put 2 over 11,776, it's 0.000 something. So that's why it's too small to count in this case. Okay. So that's how we do a vertical analysis. Here is also how it could look. This is a condensed statement. So it doesn't have as many columns here. And this is okay, so this is a comparison one. So this is looking at Chicago Cereal, which is a small cereal company, and comparing it to an industry giant, General Mills, to see how they differ. So here you have General Mills has a higher percentage of its revenue covering cost of goods sold. They have a lower profit margin, gross profit margin, than Chicago Cereal. Okay. However, they're able to squeak out, right? Their operations are more efficient. They're only spending 19.4% of every sales dollar on selling and administrative expenses, whereas Chicago Cereal is spending a whole lot more as a percentage of its dollars. Right? And thus, even when you look at their net income, General Mills has a much higher net profit margin at 10% compared to Chicago at 9.4%. So this is how you can use vertical analysis to compare within the same industry, two different companies. Obviously, you can't compare a company that's 18 billion to a company that's 11 point, almost 12 million. Remember, this is in millions, this is in thousands. You can't compare those two, they're very different. However, with vertical analysis, you can see the differences based on this percentage of how much they're spending on general things. Okay, and so this makes it very good to do an inter-industry type of thing. And that's where we're stopping today with doing exercise 2. So here we have a horizontal analysis, as you remember. Here is the information for Rose Patch Company. They have their balance sheet information for 2016 and 2017 listed here. And again, you know what you need to do, right? With a horizontal, you're looking at the difference. So current assets, the difference was $54,000. When you compare that to the original 180, current assets increased by 30%. When you look at their, it says plain, but it's really plant. I got some of them plain assets there. No, it's plant. They really increased, right? 336,000 more. 336 divided back into 420 gives you 100, gives you 80% increase. Okay, so your plant assets really increased a lot. Total asset difference was 390 divided back over the base of 600. That's a 65% increase in your total assets using horizontal analysis here. And that's where we're stopping today. How did that go? How do you feel about analysis? Interesting stuff, right? Maybe.